Vikas, hi. This is Harsh here. Vikas, firstly, wishing you and yours a happy Diwali and a very happy New Year belatedly. Talk to us about what you view in terms of the consolidation. It's been a large consolidation on the Nifty. How do you see the unwind happening? Is it going to be a gradual unwind? Are we expected to see a solid blockbuster returns this somewhat? Give us a sense quickly on what your view is.
I think wish you all and your viewers happy new year. I think of course from last year to this Diwali we saw a good amount of consolidation led by two things. One was, I think, last year around this time there was a huge liquidity squeeze in the system because of the RBI's commitment to defend rupee and also some bit of a check on the unsecured loans. I think there was a huge amount of liquidity squeeze, which I think got reversed post the new RBI governor came. And we have seen consistently growth boosting measures, including interest rate cuts to liquidity infusion to a lot of credit growth boosting measures. At the same time, government has also taken a lot of consumption boosting measures, including GST, income tax cut, as well as I think spend on the infrastructure. So I think all those things are behind us. Also, a little bit of tariff uncertainty was there around the March, April, June period, which is yet to be resolved. But I think that's not a very significant item. So as these things kind of play out, we think that from now, we've been quite positive throughout this fall of last 5-6 months, and we've been kind of telling investors to put money because we think that over next 12 months, as the growth returns, markets will do very well. We are quite convinced about the return of the growth, corporate earning growth. And it's already kind of reflecting in some of the numbers, but we are quite positive on the. So we think that it will be as more and more people believe, you will see markets getting reversal, and we've seen that playing out in last 1.5 months also. So it would be, and if the deal happens on the trade side, could be another icing on the cake. And with that, probably most of the uncertainty should be behind. But having said that, I think generally speaking, markets will have these kind of periods of consolidation, periods of run up. But my faith in India story continues to remain very, very strong, and we have never kind of got shaken up with these kind of intermittent corrections or consolidation.
You seem positive. So double-digit kind of returns, is that something we can anticipate in the current somewhat? And what are the sectors? Give us some flavor. What are the sectors which will drive those returns?
I think, this somewhat, my sense is that we will see probably 29-30,000 of Nifty. Now, when it happens, whether it happens towards end, towards early, I don't know that. Nobody can time the market, but I do believe that directionally, both liquidity as well as corporate earnings will be strong. And I think markets will be surprised on the liquidity from foreign investors' perspective, which has been on the negative side in the last couple of years. So as that comes back, you will see markets kind of doing very well. So your 15 to 20% return should be quite possible in next summer. And it will be primarily led by similar kind of sectors what has done in the past well, because ultimately India's growth story does not change very often. Now, banking and financial services will lead the rally, which it has also led in the recent past. Also, manufacturing will do well. You will see investment-related sectors do well. This time around, probably consumer, especially discretionary side, can also come back because last couple of years has been slightly sluggish. So that looks like quite promising sector at this point in time. So again, more importantly, I do believe that it will be reasonably broad-based, but at the same time, directionally markets are looking reasonably good.
So those are some of the sectors that could drive Nifty to that 29,000, 30,000 mark. Because a big number that you've thrown over there. Let's see if we're able to scale to that. And this time next year, we're also going to be interacting with you on that. So hoping that this comes true. And because you've also spoken about a bunch of sectors as well. What really stands out to me is that you are focusing on India being $1 trillion economy. And while you've spoken to us about which sectors could do well, just to play devil's advocate here, are you also spotting any headwinds on the flip side? There could be a chance that the trade talks don't go as well as we're expecting them to be. What do you think the impact could be?
Look, in markets, risks are always around, and risk always comes from the sources you don't expect, and it comes when you don't expect. So you have to be always prepared for the risk. You can never say that, but to prepare for the risk is not to be out of the market. Prepare for the risk is to be in the company sectors which you think that can withstand those risks and then come out well from those risks. So that's the only way to prepare for the risk. I think always, very often this question comes that should we sort of sell markets and come out and then. I mean, in last 12 months also, when the markets have not done well, we have had stocks which have doubled and tripled in this period. So I think, that's a very wrong notion. But at the same time, coming specific to the question about the tariffs and all, I think there could be headwinds. Who knows that what will we expected these to be done in a 15 days time, and we are already 6 months behind and still not happened. So these are a lot of issues. And secondly, I think we are in a very uncertain global geopolitical kind of scenario where the deglobalization is happening, de-dollarization is happening, a lot of conflicts will continue to remain. I think we will live in next 5 to 10 years in a heightened multipolar geo-conflicted world. And the implication of that always continues to remain, very, very sort of unpredictable and, very difficult to kind of get time. But at the same time, good part is that India's broad structural drivers are in place. The structural repairs are in place. The historical sources of risks are kind of more or less behind. And so technical risks would come, but structural risks are kind of not there. And that's the good news.
Okay, and because let's get your sense on some of these new age platform companies, the likes of Zomato, BB Fintech, Paytm. They've all seen improvement in their fundamentals. Losses have shrunk, and we've also seen re-rating to a large extent over here. Your take on platform companies, and are you bullish from a near to medium term perspective?
Yes, again, not in generic, but in specific, yes. Again, if you remember in 2021, we had written a note on this, where everybody was chasing new tech platforms, and we said it's a fad. People are investing out of FOMO and it will fade away. And I think last month, 2 months ago, we wrote a note that, fad to fundamentals. So what has changed in last 3, 4 years in this platform? That point in time, more you burnt, more valuation you got. Most of the business models were still evolving, but there was no visibility of the sort of cash flow. In last 3, 4 years, because of paucity of capital and feedback from the market, most of these platforms have moved from burning to earning. There is a visibility of cash flow, or there's a sort of mode which you can see around, right? And valuations have corrected. And this kind of sets the sort of risk reward for some of them very well. We've been owning, some of them, since last 1 year, where we could see the risk reward. When we bought Paytm at 550 rupees, we did not buy at 3,000, 1,800, or when the fall came, everything was sort of priced in, and we could see the business model transforming. So again, like I can't offer a generic comment to you, but it is specific to, because under the name of platform, anything can get sold, and hence you have to be very, very careful. And I want to be very careful guiding investors that it is all about identifying risk reward in a particular company than really knowing the sector.
Because the one key trend which is likely to play out is you're going to continue to see rate cuts, especially in the US. Would that therefore mean, in your opinion, would that mean that FI money will be more active with regard to buying Indian equities over the next 12 months? Because this 29,000-30,000 kind of Nifty target seems to suggest that. And if one were to play the FI money theme, I'm not sure if you're playing it, if one were to play it, how should one play it? What sectors?
Again, I think, that's probably, again, I would rather, sort of caveat this, that this is, you don't play FI liquidity theme, you invest into markets with a risk reward invested in a particular stock sector company. And the moment we kind of start playing these themes, we kind of do disservice to the whole investing cycle, according to me. I mean, that's just an enabling factor that if that were to happen, markets will do well. But I cannot bet only on that, right? That will happen. But I am of a strong opinion that Fed rate cut cycle coming down, sort of Fed rates coming down will have a huge flow towards emerging market, including India. That is what has happened in last 30, 40, 50 years. Every time Fed cuts rate, emerging markets do receive flows. And that would happen in India, this cycle as well. And when the water level goes up, everything goes up. It's like, you pouring more water in a particular, so when liquidity, FI liquidity, domestic liquidity doesn't matter. It is liquidity. Now, if you think that FI liquidity will put more water in the pot, I mean, water level will go up, so everything will go up. So there might be leg lead effect. First, it might be large caps because they do invest a lot more through passives, and then it could be followed by, mid and small cap. But when the water level goes up, everything goes up.
And Vikas, consumer discretionary, that's the other big theme you're playing. How are you playing that? Because and how far how far long have you been playing this since? Give us a sense, because financials, you give us a sense. You started entering a year or so back. Is consumer discretionary something that's just popped up on your radar in terms of the last 3 to 6 months? And how are you playing it? What's the best way to play it?
We've been playing this through last, almost, 8 to 10 months.
Okay.
And specifically, we added more post 15th August announcement by the Prime Minister on the GST rate cut, or the potential of rate cut or revision, where we kind of played out and we added a lot of automobiles. Unlike most people, we see automobiles as a consumer discretionary. Most people see this as a, or as a cyclical, but we see no difference. It is a great consumer discretionary play. So we've been overweight on that space for quite some time, and we continue to see that is a very, very good risk reward play. Other than that, I think generally we've been looking around. We recently bought one new company which got listed in that space. So I think whenever we think something is very good risk reward we offer, we have not historically stayed away from staples and some of the super expensive consumer discretionary, which we think don't make sense from a risk reward perspective. But whenever you think there are reasonably good valuations and the good growth in combination of these two will play out. But that, I think, amongst entire basket of consumer discretionary, automobiles offer the best risk reward.
Okay, so that's the take coming in on consumption and autos in particular. Vikas, thank you.